Manish, I wonder, to Steve's point about Omicron and the obvious knock to some activity, whether that's in services or not, should the stock market be reflecting that more acutely? Do you expect it to?
I think in the short term, it could be a little bit downside from here. I think people are looking at what happened with Delta, and just given that Delta was not such a big concern, I think most investors are thinking maybe it's not going to be as much as similarly not a big deal. But I think the difference this time is that when Delta was happening, the Fed was firmly on pause. Now we have the Fed hiking, and I think that is the key concern here. That because now they have to balance the high inflation, the good inflation that he talked about, along with a potentially soft patch, driven by Omicron. I think that's what makes it a little bit more volatile.
Right. Lindsay, how much risk do you think that infuses into at least Q1 trading?
Yeah, I mean, I think Q1 trading is going to be volatile. It was always going to be volatile given the uncertainty that still remains around the Fed policy tightening plan. We don't know exactly when they'll start or at what rate they'll continue to raise rates. So that's going to be a key focus. But Omicron right now, it's just a reminder that the COVID crisis really is what's going to determine the trajectory of the economy and earnings in the year ahead. And so that's something that we're going to continue to watch. That being said, I do think that this is a delay or a kicking a can down the road with regards to growth, not necessarily a growth shock that we're going to experience. And perhaps the market has already priced that in. If you do remember, when the Omicron variant started breaking out here in the U.S. in late November, early December, the market was very volatile, took a big hit before bouncing back and continuing to be volatile through the month of December, even though the overall market has done well over the past month. There has been a lot of damage underneath of the surface, and I think that investors have prepared themselves for a slowdown in growth in Q1 at this point in time.
Manish, where do I want to be exactly in the market? If you're right, if the Fed's going to be tighter in 22, have, let's say, high growth, high valuation technology stocks, the NASDAQ 100 names, have a lot of them come down enough? Have their valuations been reset enough that I feel safe buying those stocks in the kind of environment you anticipate in 22?
I think so. So I think it depends, not the overall, all growth stocks are reasonably valued. But if you look at, in particular, some of the fan mags, I think the interesting thing there is that they're trading at not too high a premium relative to the 2019 numbers. Now, you can say that perhaps you're going to go back to normal and rates are going to go higher, but it is hard to believe that their profitability, their market share, all the gains that they have made since then that deserve definitely a higher valuation. So we feel comfortable on that front. Going back to the rate story, I think it is definitely a story that people talk about, that high rates are bad for growth stocks. And indeed, that has been true for the last 2 years or so. But if you go back just a few years back, or if you go back even longer, it is just not true that the high rates necessarily hurt growth. I mean, just go back to 17. Real rates were going up, yet growth continued to outperform. So there is some link, but the link is quite tenuous. So we're not that worried about high rates for growth stocks.